Why do 70 to 80% of businesses not sell? And why do so many owners regret it? Let me begin with 3 statistics every business owner should understand. According to research from the Exit Planning Institute, 70 to 80% of businesses brought to market do not sell. 50% of businesses that do sell involuntarily due to the 5 Ds: death, disability, divorce, distress, or disagreement. 12 months after selling, 3 out of 4 owners report regretting the decision. Those numbers are not minor, they are structural. Most businesses never sell. Half of those that do were not planned, and most owners regret their experience afterward. Why? Because exit planning is not a transaction, it's a long-term strategy. The 5 Ds where value can collapse. When a business sells because one of the 5 Ds, it is rarely selling from strength. It is selling under pressure. Death, disability, divorce, distress, and disagreement. The death component of the 5 Ds is deeply personal for me. My father drowned tragically in a fishing accident. He owned a jewelry store, but he had not created an exit plan. In the aftermath, we were forced to liquidate his inventory for pennies on the dollar to provide care for our stepmother. What should have been a preserved legacy became a distressed sale. I understand firsthand how devastating an unplanned transition can be, and why thoughtful exit planning is not optional but essential. These events are emotional and disruptive, and when urgency drives the transaction, value declines. Buyers recognize when an owner must sell. They negotiate aggressively, lower multiples, tighten deal terms, and extend payouts. A company that could have commanded a premium in a planned transition often sells at a significant discount when forced into the market. That is how wealth erodes. That is how decades of work can potentially lose value. Then there's the demographic reality. Baby boomers own approximately 63% of private businesses in the United States. That represents 4 million businesses and nearly $10 trillion in wealth, much of it concentrated inside privately held companies. This is the largest generational wealth transfer in history. Yet, succession assumptions are risky. Only 30% of family businesses transition successfully to the second generation. 12% reach the third, 3% reach the fourth. Assuming continuity is not a strategy, preparation is. Owners know it matters, but usually delay taking action and creating an exit plan. Research shows that 99% of owners agree having a transition strategy is important. However, 78% have no written plan. 49% have done no planning. 85% have never had a formal valuation. 80% have no formal value management program. The issue is not awareness, it is urgency. Exit planning remains important until one of the 5 Ds makes it urgent, and urgency compresses value. 3 out of 4 owners regret selling, and that typically stems from 2 areas. They discover a wealth gap, the difference between what they expected and what they actually received. Owners overestimate business value, underestimate taxes, and fail to account for deal structure. For decades, the business defined their purpose, rhythm, and structure. Without a plan for life beyond the company, the exit feels disorienting. A successful transition requires 3 aligned components. Number 1, transferable business value. 2, personal financial readiness. And 3, a clear plan for life after exit. If any one of those is missing, dissatisfaction often follows. Exit planning is operational strategy and can benefit the owner years in advance of selling. Exit planning is not something done at the end. It's how you operate the business today. An exit-ready business is more profitable, less dependent on the owner, lower risk, operationally stronger, more attractive to buyers, and more valuable. Value is built years before a transaction occurs. This includes increasing EBITDA, improving valuation multiples, reducing concentration risk, strengthening leadership depth, cleaning up financial reporting, managing tax exposure, preparing for unsolicited offers. When you prepare in advance, you sell from leverage. Without preparation, life determines timing, and the market determines price. The real question is, do you want to choose your exit or have it chosen for you? Because when one of the 5 Ds drives a decision, value rarely reflects potential. If you're a business owner, consider this. Obtain a formal valuation, understand your value gaps, understand your wealth gap, understand your profit gaps, understand your performance gaps, understand your workforce gaps, understand your product and market gaps, evaluate readiness versus attractiveness, create a written transition strategy, integrate tax planning well before a sale. The objective is not to sell tomorrow. The objective is to build a company that is transferable, profitable, and aligned with your long-term financial goals, even if you never sell it. Preparation creates options. Options create leverage. Leverage protects value. If you're a business owner with $5 million or more in revenue and want clarity around your valuation, exit options, and tax exposure, I invite you to schedule a private strategy session. We will evaluate your current business enterprise value, identify potential gaps, personal financial readiness, tax mitigation opportunities, market positioning, premium versus discount risk. No pressure, just a disciplined strategy, because the difference between selling at a premium and selling under pressure is planning. And planning begins with a conversation.